why our next guest compares the U.S. economy to a motorcycle in Manhattan. Ryan Lamond of Neo Vision Wealth Management joins us in a moment. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. President Trump's pledge to impose tariffs on all imports of steel and aluminium has pushed commodity currencies and Asian stocks lower. Our next guest says if 2024 was the year of uncertainty, 2025 is shaping up to be the year of sheer market whiplash. Joining us now is the CEO and co-founder of Neo Vision Wealth Management, Ryan Lamond. Well, in our tease out to you before the break, we were saying that you've compared the U.S. economy to a motorcycle in Manhattan. What does that mean? Not that I've ever driven a motorcycle in Manhattan, but please explain to us.
Listen, the U.S. economy and the U.S. as a country is just like a semi-truck. The way you adjust it, small adjustments, predictable, where you know where it's going. At the moment, the way it's being driven is literally like a motorcycle zigzagging in the streets of Manhattan. This is what I meant by it.
Yeah.
It's so destabilizing for all market players.
Yeah, so how do you navigate the fact that there is so much uncertainty stemming from quite a volatile U.S. president and not stemming from the data itself? As a trader who's got access to all of this information, what do you place more weight on? Is it what the administration is saying, or the data that's coming through for the economy?
Well, Jemina, let me tell you, in 2017, I was sitting in that seat there talking about exactly the same thing. We used to tell our analysts, open Twitter before you open your Bloomberg terminals. Unfortunately, yes, we have to look at what he's saying because this is what's impacting markets today, the economy and the world. Like we've seen tariffs on steel and aluminium just mentioned, and China just announced 15%.
Yeah. So let me just flag something else that has happened in the markets that is also quite interesting and nothing to do with President Trump, and that was the arrival of DeepSeek. My colleagues in Asia have been tracking the big Chinese tech outperformance versus U.S. tech versus NVIDIA specifically. Perhaps that actually is a bigger event for markets than all of the noise around tariffs every Monday.
Oh, 100%. Let me tell you two things. One, no one can compete with China on price, development, and the way it does things. No one. We've seen it in EVs, we've seen it in mobile phones, and it was inevitable to see it on AI as well. The arrival of DeepSeek, in my opinion, is not very innocent. The timing of it specifically. They were waiting to see what's happening, and you see the announcement. It's very timely, actually. We expect more to come because now trade war has started between the U.S. and China. And China knows very well that the U.S. stock market's Achilles heel is tech, it's semiconductors, and it's AI.
Yeah, so who wins the trade war? Is there a winner in a trade war, or is everyone a loser?
In a trade war, no one wins.
Okay.
No one. The biggest loser is the consumer.
Yeah.
And ultimately politicians. Their mandate ends, they move on, they continue to benefit from their benefits, and that's it.
Yeah, so you and I spoke a couple of months ago. You were underweight the U.S. tech sector.
Absolutely.
U.S. tech sector has actually continued to perform well.
Yeah.
Do you feel like you're missing out by not being involved there?
No, because we've done very well, one on gold, and we've been long gold on this stage as well. In 2023, I think, 25% of our portfolio is gold. We have Chinese stocks. We've done very well on multiple Chinese stocks. You've seen Alibaba. That was fantastic. Indian stocks. So we've done very well. And so we haven't missed any performance, minus the volatility and risk budget.
What do you think derails the thesis for Chinese tech stocks here?
Is the trade war going worse and worse, whereby becomes destructive? Again, everyone loses in this case. And yes, the stocks can be a victim here. That's why we're hedging.
Yeah. Let me ask you about gold. I know it's one of your biggest positions. A big percent of your portfolio, 25% of your portfolio has been in gold. It's done extremely well.
Yes.
We're getting close to $3,000 here. If you were an investor who was not already involved in gold, would you still buy at $3,000?
Absolutely. All of the components for gold to be going up are still there. Production of gold is at a shortage. Central banks are still buying. Geopolitics is still an issue. We have a trade war. All of these, it's an intersection of many factors that are pushing gold up, and they will continue to push it up.
Positioning is quite long, though. So how do you think about that and the potential for I mean, we've seen it several times over the course of the summer. Whenever positioning is extreme, you tend to get whiplash effects and pullbacks in the market. How do you think about the length of positioning in gold right now?
If you look at banks today they have the largest short position on gold that we've seen until now. So we will see volatility. Any dip is an opportunity to buy. So maybe not buy at current levels, but let's wait for the next dip and buy. From our side, we're continuously buying as per the proportions of our model portfolio.
What about the strength of the USD on all of your thesis that just outlined?
The USD will remain strong for the foreseeable future, minus the yen, because we do think that the BOJ will raise rates and the yen will be the exception until President Trump decides that it's no longer beneficial for the US to have a strong dollar. But as long as he does, it will remain strong.
Yeah. Ryan, always good to chat to you. Thank you so much for coming on the show and spelling out your views. Ryan Lamond, CEO